Uh, Hello and welcome, everybody. Thank you for joining in again on a new edition in Kotak Cherry 2023 in Focus. And today we have with us a very special guest, Mr. Saurabh Mukherjea, CIO founder of Marcellus Investment Managers. Welcome, Saurabh, sir.
Thank you, Shubham. Thank you for inviting me.
Thank you. Thank you so much for joining in today. Saurabh, sir, we've seen how 2022 has gone by, various global macro factors in play, markets being volatile, yet Indian economy and Indian markets, sort of doing better than what the rest of the global peers are doing. How is Indian economy stacking up so well compared to, US, UK, and China?
I think the main difference between us and the rest of the world has become our labor market and our labor supply. The commodity issues are obviously common to the whole world. So if Russia and Ukraine are fighting a war and oil prices are going up, that pretty much affects the West, China, and us relatively uniformly. But the difference is the labor market. The entire Western Hemisphere, especially Europe, to a lesser extent, America and China, have ended up with a demographic issue. The birth rates peaked in the Western world in the mid 60s. That generation which was born in the mid 60s is retiring at a rapid rate in the Western world, and there aren't enough young people coming through. You have therefore epic labor shortages of a sort that I've never seen in my life in America, in Europe, and even in China. The result of that is runaway wage inflation, which means that we have suddenly become a very competitive economy. So small Indian companies or giant Indian firms are finding their products, their services to be extremely competitively priced. It means at a country level, our CPI inflation is significantly lower than that of the Western Hemisphere, which means our interest rates have to go up less, which means our economy has been less adversely affected than the Western world's or China's has been over the last 12 months.
Right. And Saurabh, we've also seen how foreign institutional investors have been, taking money out of emerging markets, and India has been no exception to it. But of late, in the month of November, we have seen, good uptick in terms of foreign institutional money again coming into India markets. What drives this change of guard?
So this is relatively simple, right? Given that not just in the year ending not just the year ending December 22, but for several years to come, we will be by far the world's largest fast-growing economy. So if you take the current year, the year that will end in December 22, if you take December 22, the year ending December 22, we will grow at around 7%. No other large economy will even grow at 3.5%. So if you are the world's fastest growing large economy, and it looks likely that this will carry on for several years, you're naturally going to attract a lot of FII money. There's another way to think about it. Foreign investors have $3.5 trillion invested in the Chinese stock market. The Chinese stock market has given 5% returns over the last 20 years, right? 5% dollar returns over the last 20 years. Foreign investors have a mere 0.6 trillion, 1/6 of what they've invested in China. Foreign investors have invested in India, 1/6. The Indian stock market has been the world's second best performing market over the last 20 years, 14% dollar returns. China has given 5, India has given almost thrice as much. Foreign investors have 1/6 the investment in India as they have in China. As night follows day, in the next couple of years, we will end up seeing a significant part of the 3.5 trillion invested in China by foreigners will be moved to India. Even if the foreign investor shifts just $500 billion from China to India, just $500 billion from China to India will almost double the FII's investment in India over the next 2 to 3 years. And that's why I'm very excited about where India is today. Competitively, we are finding our economy to be competitive. Our GDP growth is almost twice that of any large economy. And as you've said, foreign investor flows are heading towards our market. Scarcely a day passes without a foreign investor coming to Marcellus's offices for 2 hours, 3 hours. In fact, they don't want to leave. We have to actually tell them that please, can you leave? We've got other things to do. And I think this state of affairs will persist, Shubham, for many years to come.
Right. Right, Mr. Saurabh. So, if you look at the other way around, what has also supported Indian markets is the resiliency which domestic institutional investors have shown. Do you expect this trend to continue going forward? There have been various articles coming on news as to how, the SIP investments specifically have gone up in the Indian market space. And how do you see this trend sort of spanning out in the next couple of years?
So I think this is not a couple of years. I think this is more likely to be a couple of decades, right? So if you look at the data that the RBI has been publishing for many years now, the RBI has repeatedly said that Indian households have 95% of their assets in physical wealth, which is real estate, land, and gold. As everybody who's listening to this broadcast knows, physical wealth rarely compounds at more than 7-8%. 7-8% after tax is 5-6%, which is same as the rate of inflation. In other words, 95% of Indian households and investments, which is physical wealth, give you zero real rate of return. Right? It doesn't take a genius to figure out that households are fed up with that style of investing. Why should I invest in land and gold and real estate if after tax I can't get a return better than inflation? The main asset class in India, which gives inflation beating returns even at the index level and certainly at the portfolio level, is high quality equities. And that's why in the last 5 years, we've seen basically $50 billion a year come into the Indian stock market from Indian families. And if you add insurance and life insurance and general insurance, you're looking at roughly $100 billion a year over the last 5 years, $100 billion every year coming in from households to the stock market. Even then, we are at 95% in physical, 5% in financial. This number will keep improving in favor of financial. I reckon over the next 10 years, Indian households will comfortably invest $1 trillion in the stock market plus insurance assets.
If you look into the Indian economy per se, and specifically if you talk about banking as a sector, banking sector has shown a lot of resiliency. The numbers in the Q2 which were published, they were better. How do you see this particular sector doing, considering the credit growth and all have picked up year on year? The numbers are there. It's in high double digits at present. Is this trend expected to continue going forward?
So if you look at the banking sector, right, roughly 7-8 years ago, it was in really bad shape. Huge NPAs, stress in the banking system. The banks didn't want to lend. The crony capitalists were riding high. A lot of hard work has gone in on the part of the RBI and the banks to clean up their act. The banks' balance sheets are cleaner. They're really well capitalized now. And what you therefore have is a beautiful confluence of factors. You have the beginning of an economic recovery. You have banks with excess capital sitting on their balance sheets, not least the bank that you work for, Shubham. Excess capital sitting there, economic recovery beginning. Thirdly, the combination of UPI, RTG, and PS means banks now have enormous amounts of digital data. Banks have enormous amounts of digital data with which they can see which small business is doing good work in terms of the flow of business for SMEs. They can use that to drive better working capital decisions, better credit decisions, right? So beautiful confluence of factors, economic recovery, strong balance sheets, plenty of digital data hammering into banks' IT systems. And what I'm seeing therefore is well-run banks and NBFCs in India growing their loan books at 25% for several years to come. And we've already seen that to a certain extent, right? The bank you represent, several other NBFCs, other banks in our portfolios have been doing really well. And I think this continues for a few years. The challenge will occur 3-4 years out when the economy overheats and the economic cycle starts turning down. That's when I think high quality lenders will face their first challenge.
Right, Mr. Saurabh. Saurabh, very quickly, markets at near all-time high. How should an investor, rather, what should an investor look forward for in the next year?
Well, look, the thing to be careful about when a stock market starts rallying like this, and I think the stock market rally will sustain, is be careful about not getting locked into low quality stocks. A lot of people in our country have a fascination for what are called Sasta stocks, low PE, low PB multiple stocks. Unfortunately, many of these stocks are public sector entities. In many cases, they're metals and mining companies. Often they're companies with low quality corporate governance. And my consistent suggestion to Marcellus' clients is avoid these sorts of names. They look very tempting because it looks sasta superficially, optically sasta lagta hai. In a bull market, it runs up as well. So it draws more retail investors into the stock price. And then kaput one day, it blows up and 95% of the shareholder value evaporates in a few months. I've seen it again and again. I saw it in 2009, 10, 11. I saw it again in 2016, 17 in the NBFC meltdown. And therefore, my suggestion to those who are watching is focus on clean companies, where the promoters' integrity and the accounting integrity is of a high order. Secondly, promoters and companies where capital allocation is sensible. How do you know it's sensible? Return on capital should be consistently above cost of capital, which is roughly 15%. Return on capital should be consistently above 15%. And third thing is look for dominant franchises. Franchises who are able to charge their customers 20, 30, 40% extra premium pricing. And the customer still says, I'm happy to pay the premium. I don't want a discounted Sasta product, right? If you invest in such Indian companies, my experience of India, which I've written it up in my books, in Unusual Billionaires, in Diamonds in the Dust, my experience of India is this sort of investing really works out nicely in our country. So as we come out of the potentially, and fingers crossed, as in 2023, we come out of the tragic Ukraine-Russia war, as we come out of the commodity upsurge, which had pumped up inflation further, and as interest rates start normalizing through 2023, you will see that style of investing, clean, well-run, dominant franchises doing well. The notion that you and I can buy optically Sasta stocks and sell them high, the notion isn't founded in reality. Do the right thing, do high-quality investing in India, and prosper from the upsurge in India's competitiveness and upsurge in India's standing in the broader world.
Right then. Thank you, Saurabh, so much for providing your valuable insights to our audience.
My pleasure.
Hope our investors would benefit from the same. Thank you so much, Saurabh, once again.
My pleasure, Shuman. Thank you for having me.